Hello and welcome to Switzer TV, and today I'm talking to Simon Shield, who's Portfolio Manager at Monash Investors. Thanks for joining us, Simon.
Hi there, Peter.
It's a good time to talk to you because a lot of people are a little bit nervous about the volatility in the stock market right now. Why don't you tell us about Monash Investors?
Well, Monash Investors was set up about 6 years ago, the idea being that we would focus on absolute returns rather than relative returns, even though we were investing in shares in the Australian share market and doing it as a bottom-up fundamental investor.
Okay, now a lot of people watching this wouldn't know what you're talking about. So let's just go through and make sure they do understand. So a bottom-up investor?
Well, we look at the fundamentals of companies. We're not interested in quantitative investing. We're not interested in trend following or just reacting to the momentum in share prices.
Yep.
We look at the earnings of companies, we do our own modelling, we do our own company visits, we come up with what we think is the right valuation for those companies and we invest on that basis.
Okay, and absolute return?
Well, again, the vast majority of fund managers out there are trying to beat the benchmark. Typically that's the ASX 200. And when they create their portfolios, they worry about the risk around that index. We're not interested in that. We're there just trying to make money for our investors and doing that on, over the medium term, getting a double-digit return.
Yeah, okay, right. So why do you believe it's important to have exposure to absolute return funds?
It gives diversity to their Australian equity exposure. And what we've shown is that we can do that without giving them a lower return to the market. In fact, in many years we give them a better return than the market. So they get an equivalent return to the market, but with great diversification.
So I guess there could be a lot of people watching this who've said, look, I don't understand stock, but I want to be a part of the stock market. So they bought an ETF, which gives them the ASX 200, which means they'll match the index. But if they wanted to add some extra oomph, they would look at a fund like yours because you're going to try and beat the index.
In fact, we just want to deliver double-digit returns per annum over time, and so we do that by having a lot more flexibility. We can do things like shorting stocks as well as going long. We can hold lots of cash if we want to. We can use derivatives to protect the portfolio at times. So there's things we can do that a typical manager would not do, and as a result, we can give a return that is much more of an absolute focused return.
And in a sense, you also help people get some more diversification in their portfolio as well. Okay, so how does an absolute return LIC, we'll explain what a LIC is as well, differ in strategy from other funds? I think you've pretty well explained it, but let's get it in a nutshell.
Well, it really comes down to looking at every investment on its own merits, not thinking about it in terms of what is my exposure to a sector, how does it compare to the other stocks in the sector. We're not interested in that. Every time we make an investment, it's on its own merits. We're looking to make money, whether it's a long or a short position. Okay,
and you should explain what a LIC is, because some people who are watching this might not know what a LIC is. Yeah?
Well, a LIC is a listed investment company. So a fund manager can have unit trusts where investors go and buy and sell units at the NTA and they get that from the manager, or it can be the fund can be listed on the share market as an LIC, in which case the investors get the market price, whatever a buyer or seller will pay for that unit on the day, but it's broadly in line with the net tangible asset backing. Yeah,
okay. So can you explain to my viewers the difference between long and short trades? Because that is an important difference between long-only fund managers and an absolute return manager like you.
That's right. So long-only is when you buy a share on the share market. That's a typical thing that investors do. Whereas shorting a share is around selling a share you don't actually own, so that if the share goes down, you make money as an investor. Now, you're not allowed to short a share without borrowing it first. So you need to find somebody who will lend you the share, but once you've got your hands on that share, by borrowing it, then you're allowed to short it. It costs money to borrow, so there's a small interest rate associated with that.
Yeah, and ultimately you do that because most of us like to pick a stock where we think the price is going up. But in a realistic sense, you look at some companies and say, well, I think it's more logical that the price is going to fall, so let's try and make some money out of that observation that you've made.
That's exactly what we do.
Yeah, okay. And you don't do it because you're nasty or anything like that.
No,
it's just you're interpreting where the market's going.
That's right.
All right, so tell us about a recent stock investment in the fund.
Well, we recently invested in corporate travel because the share price fell quite a bit, and when we do our analysis of what it's worth, now there's a lot of upside to our price target. Begs the question, why did the share price fall like it did? Well, there's a activist investor called VGI that's come out and has made some claims about the company. The most important claims it's made has been about its cash conversion and also the recognition of revenue for the stock. Now, these guys have been short the stock for some time. They've made similar claims before. They've just put out a big document this time in a way they hadn't previously, and it's affected the share price.
Yep.
We've looked at that. We've seen that as a real opportunity. We don't think there are any material basis for the claims, and we're taking advantage of that.
Okay. So in simple terms, a hedge fund manager who was short the stock has put a report out saying we're right in being negative on the stock. Journalists have then published the story. The market has, in the first instance, reacted negatively,
It's
which
been
the market,
very spooked.
yes, and markets often do that. But then you've done the analysis on the company and others as well. And what is the overall market reaction now to that company, corporate travel?
Well, the stock price has really settled down. It's bounced from its low of about $20 and is currently around the $22 mark.
How high was it before the report came out?
I was up closer to 30.
Yeah, so it was a substantial
fall, and we see no reason why it can't get back up to 30. It's a stock that has tended to trade on higher multiples because it's had a high growth rate over time, and we don't see any slackening of that growth rate. In fact, ironically, just before or around the time that VGR came out with its short, it had an earnings upgrade. It's a business that historically has run very well.
Okay, and I guess explain to my viewers what corporate travel does, because it's so obvious, but it just explains. So what is it? Because you need to think, okay, if this is what they do, what's the outlook for that industry?
Yes, well, corporate travel is a travel agent, much in the same way that Flight Centre is a travel agent, but corporate travel focuses more on the corporate market, not on the retail market so much. And they've done a terrific job in Australia, and they're growing their business overseas. Some of that has been by acquisition, but typically when they acquire those businesses, they improve them and they grow their margins and their revenues quite strongly.
Yeah, and I guess if the outlook for the Australian corporate sector was weakening, you'd probably say, well, maybe the potential for this company to do well would be weakening as well, but the opposite's the case. The outlook for Australian corporates is actually very positive at the moment.
It is, and also with the increased overseas diversification, Australia becomes less relevant as well.
Okay, so how does this product relate to self-managed super fund investors? Now, the product being your Monash Investors LIC.
Yeah, so where this fits is we're able to do things for the investors that they can't really do for themselves, right? So we've already mentioned shorting the stocks, and we're a long bias portfolio. We only short opportunistically as we see these opportunities. So, you know, for the vast majority of the time, they're going to have a relatively full exposure to the share market, augmented by some shorts in the portfolio. But that's not the only thing we do. We also can be very flexible in our cash allocation in a way that perhaps they might be reluctant to as long-term investors in the market. So, for example, about a month ago, we had 40% cash in the portfolio when the market was really falling quite a lot last month, and we took that opportunity to actually get in at pretty much the lows and get ourselves back to about a 95% exposure.
And so that's approximately where you are now at this time, when a lot of people are scared because of the volatility.
Absolutely right. Yeah, that's the idea. We want to buy low, we want to sell high. Well, one of the other things we do also is we do a little bit of pre-IPO, so no more than 5% of the portfolio. And again, that's something that typically they can't do for themselves.
Yeah. So if an IPO is coming up, you give yourself a fairly big exposure to some of those IPOs.
Or actually, if it's coming up in 6 or 9 months, we could be in a funding round prior to the IPO and get an uplift to the IPO price, let alone what it does after the IPO.
Okay, great. And I guess one last thing is that, given your actions that you're buying at the moment, your view on stocks and this present correction, you must think this is purely a buying opportunity correction rather than a prelude to a crash?
Very much so. Really see this as the sort of correction you get when stock price has been strong for a while in a strong economy. And one of the, if you like, symptoms of a strong economy is that interest rates start to go up a little bit and inflation starts to go up a little bit. That's not a reason to get out of shares. That is a time when shares actually do much better than bonds, obviously. And there can be a little bit of volatility on the way through, but really we just see that there's no reason for that trend in the global economy not to keep on going.
I think one last question a lot of people would like me to ask you is, you talked about shorting. Is there a stock at the moment that you're shorting?
We are. We've been shorting Coca-Cola for some time. That's to do with the trend against sugary drinks and you know, sugary beverages in general, because of course they also do fruit juices and energy drinks as well. And globally, Coca-Cola's been seeing around a 5% fall in the CSD sales, that is the sugary soft drink sales, for the last several years. We've got some other shorts in the portfolio as well, particularly now that there's a Royal Commission of the aged care sector, at a time when not just the Royal Commission is going to be dampening people's perception of the stocks, and we've seen that with the AMP, for example. We saw that with James Hardie years ago, but also at a time when property's under pressure, and these companies have a lot of exposure to property because people typically have to sell their properties in order to buy into the aged care centres.
Yeah, exactly right. Great stuff. So that's Simon Shields from Monash Investors, giving us some pretty good insights into what he does and why he does it. Thanks for joining us on Switzer TV.